A wonderful evening to all of you. I'm Magdalene from Itus Capital, and I'm glad to welcome you all to our 1Q Investor Call 2025. Thank you all for taking the time to be a part of our call. At this time, all the participants will be in listen-only mode, and after a brief presentation by our founder and fund manager Naveen Chandramohan, we will have the Q&A session. Today, Naveen would walk us through on our portfolio performance in the quarter gone by and discuss his views on the market. Let's hear it from him. Over to you, Naveen.
Thank you, Magdalene, and thank you so much to everyone who's logged in into the call today. Today, what I'll aim to do is walk you through the historical performance to start off. There have been quite a few changes in the portfolio construct that's been made in the last 4 months. I'll talk you through the positioning, thought process, and what changes did we make, and give you both the macro, which is a top-down, as well as a bottom-up view on how I think through the markets today, and what you as investors or allocators should expect from the markets over the next 1 year, the way we see it. And more importantly, what should, if that is the base case, what should you expect from this portfolio over the same period? And it's a very conscious decision that I'm telling you 1 year, primarily because obviously there is a lot of geopolitics and headlines and news at risk. So as investors and allocators, I don't think people are looking for a 5-10 year view. People are more so looking at what do I think about, how's my money going to work in the next 1 year, and as I take it beyond that. So first, we'll start off by reviewing the performance. Since inception, if you look at our portfolio, for investors who've been with us for the last close to 8 years right now, 1 CR is roughly worth 3.91 CR post fees and expenses. This is as of March 25. The same invested in Nifty 50, which would be the benchmark index that we're talking about, would be roughly worth 3.17. This annualizes to an IRR of 17.98% post fees and expenses. This slide breaks down the year-wise returns as we speak. As you can see, in 2025, in the first quarter, we had an underperformance in Jan and Feb, an outperformance in March. And so far, even through the volatility in April, the fund has shown consistent outperformance, which I would expect for this fund to continue through the rest of the year. And I'll take you through why I'm making such a statement. Now, I'll start off by talking through how do we think about macro. I always use this analogy, right? I mean, every fund manager or analyst or anyone who invests in the market talks about, I want to invest in good companies. And good companies are defined by the P&L in the balance sheet of the company that you look at. Very similarly, macro to us is the P&L and balance sheet of the country. So to put it in very simple terms, there is a revenue for the country and there is an expense that the country spends on. Now, most of your revenues are going to come from 3 components, which is service tax, corporate tax, and income tax. Service tax is what transitioned to GST in 2017. So back in 2010, corporate tax used to be 40% of the revenue for the government. Service tax used to be 10, and income tax used to be 20. Come fast forward in 2025. Today's service tax, which is GST, is right now close to 30%. So not only has the magnitude gone up, the contribution has gone up. Corporate tax has gone down from 40 to 28, and income tax has gone up. So the simplest way to think about corporate tax is if EPS of corporate India goes up, corporate tax should go up. So then why is the contribution of corporate tax gone down? Is primarily because in 19, we cut our corporate tax from 35 to 25. That's a 33% cut. So you will see a drop from a contribution perspective. So now that I have set the context, it's an important thing that to go slightly deeper into what is called as income tax. Now, income tax is normally the people like you and me, what we pay as tax every year. Now, there is a small component of that, which is market linked, which is the sum total of LTCG, STCG, and STT put together. Now, India in the last 20 years, pre-COVID, this market linked tax as a percentage of the total gross tax revenue used to be between 0.5 to 1.1% over the last 20 years. Now, post-COVID, obviously, through equity participation, depth of the markets, and equity rally, as of FY25, if you look at this chart on the right, today it's at 5.2% of the total gross tax revenue. Now, what's the implication of this? I'll explain to you on the next slide. Now, this slide on the left explains and breaks down the total net tax revenue, which is what the government earns. As you can see, year-on-year numbers will be volatile because it could be a low base. For example, 21 to 24, that CAGR would be around 18.5 to 19%. Pre-COVID, it was closer to 5 to 6%. But overall, over the last 15 years, it's grown between 8 to 9%. So when the government does its budget and it guides you for next year, it assumes that the next year, unless barring any untoward event, their tax revenue will grow by that usual 8 to 9%, which is what they have done in the budget for 25-26 also. The implication of that is the market linked tax revenue implicitly they are assuming will grow, which is the biggest risk, because if the market falls, like what we've seen in the last 6 months, a large part of your LTCG and STCG will go away. So what the government is budgeting implicitly without telling you this is roughly your market linked tax revenue will be 5.6 to 5.7% of your gross tax revenue for FY25-26. The way we see this number is going to be closer to 3%. So there is going to be a 3% revenue deficit that you will be hit with this year. I think it will become clearer as you go into subsequent quarters. What is the impact of that? So what we covered is the revenue side. Now we'll go into the expense side. One of the most important parts where the government spends is Capex. As most of you are aware, between FY20 and 24, our Capex grew by almost 26%, which is what this chart on the right shows you. So the growth was robust. So the government basically came and said in FY26, they are guiding for a fiscal deficit to drop to 4.4%. So if your fiscal deficit has to drop, which means effectively you're generating higher cash flow in order to cut down the debt, then you have to cut down expense. Now, they have already guided for your Capex only to grow at 10% for 25-26. But because the revenue is at risk, this number can drop even further. So the sum total of all these 4 charts put together, if I was to give you 3 takeaways, they are as follows. The risk on the revenue side is the government may not make as much as revenues as what they have budgeted for. The implication for that is Capex spends should be lower than what they are budgeting for, as a result of which for the next 4 to 5 quarters, you will see our portfolio underweight Capex. Right? So this is broadly what I wanted to communicate. So if you look at our portfolio from October to January, you would have seen roughly 20% of sales predominantly coming from these themes. So because many of them have written to me saying, why has the churn increased in the last 3.5 months? The churn increased because I had to reposition risk. We had to cut down Capex from October onwards to January, and that was reallocated somewhere else. Where was it? I'll cover it at a sectoral level shortly. So you will not see churn higher from here. What rebalancing had to be done has already been done in the last 4 to 5 months. Now, the second aspect of macro is thinking through how we think about concentration, right? Again, many people have been asking me for a good part of 24, why is your portfolio having 37, 38, 39 stocks? There are too many. And the answer to that was never about saying what is too many. The answer to that is, how do I give you guys a framework to think about when should you concentrate, or at least when will Itus concentrate, right? If you took a today look at our portfolio, it is a lot more concentrated. Why? Right? So I'll give you a framework to think about concentration. It doesn't mean it has to work every time, but it's just to give you a history. So what we did was we took NSE 500, which is the top 500 companies in India, and we plot what is called the concentration index. So what is concentration index? So I'll explain it in a very simple language. Let's say there is one stock in your index. The weight of that stock is 100%, right? So the concentration index is the summation of weight square. That means all the individual companies weight square. Why am I doing it? It's very similar to how inflation is done globally, the HHI index. So you normalize it. So in this case, it will be summation of 100 square, that's 10,000. Assume there are two stocks in the index, each being 50%. So in this case, it will be summation of 50 square plus 50 square, that's 5,000. So what you will see is as the number of names keeps increasing, concentration index will keep falling, right? So if you plot NSE 500's concentration index over the last 22 years, you will get a plot like what I have shown you in this graph. So you'll see it's a random plot according right now, but I'll put some definition into this randomness. So you'll see periods of concentration going down and up. So it's random, right? But on purpose, every time the concentration has gone down, I've put it in green. And every time the concentration has gone up, I've marked it in red. Why is that? Because next to this green and red, you'll see three numbers. These three numbers are the annualized IRR of Nifty 50, Nifty mid cap, and Nifty small cap over these periods. So, for example, between 21 and 24 end, roughly around slightly over 3.5 years, the concentration index went down, which meant the mid and small cap gave you 37 and 35% IRR as against Nifty 50 at 23. You'll see the same pattern across time. So every time the concentration index goes down, mid and small caps outperform. That's why their weights increase. Every time the concentration index goes up, mid and small cap tend to underperform. And you are seeing a turn, which is what I have marked here, where the concentration index is increasing after a period of 4 years where it's reducing. So what does this mean, right? This does not mean you have to go and sell all your mid and small caps, because that's not what I'm saying. I'm saying just because mid and small caps have fallen 25%, many people want to invest in the index. I don't think it's a broad-based rally anymore as far as mid and small caps is concerned. But doesn't mean you have to blanket sell it. So for example, between 18 and 20, this was a period where mid-cap index gave you a negative 8% IRR, small-cap index gave you a negative 15% IRR, and Nifty 50 gave you 2% IRR. But your best performing sector in those 2 years was the chemical index, which gave you as an index an 18% IRR. And chemical index was only mid and small caps. So I am not saying no mid and small caps will do well, but I am saying a blanket mid and small cap will not do well, because at least from a probability perspective, it doesn't make sense as far as we are concerned. And it goes in line with what we have been seeing in the last 2 quarters, where earnings have been narrowing. And I expect that to continue. What does that statement mean? And I'll put some numbers to this. As of June 2024 quarter, 53% of Nifty 500 companies beat the Nifty 500 average. As of September 2024, that number dropped to 44.5. As of December, it dropped to 41. And I expect this to drop further. So fewer companies are beating the average. Fewer companies are going to perform as far as we are concerned. So the same thing, we've done it from a price chart perspective. So what's the chart on the left? It tells you the Nifty 500 index performance between September and December 2024. The chart on the right is the Nifty 500 performance between Jan and March 2025. As against the Nifty 500 performance, we put the median return. Median is the 250th stock return. So in a broad-based market, the median return will beat the Nifty 500 because more of your stocks will outperform, right? Whereas in a narrower market, as you enter a narrower market, your median performance of your stock will underperform the Nifty 500. And this underperformance will widen, which is what you are seeing in as you go from September deck 2024 to Jan March 2025. And I expect this trend to continue. What does this mean? This is now a market where concentration can pay off. Why? Because fewer companies tend to outperform from an earnings perspective. If you can position your portfolio now, where valuations are also comfortable and fewer companies outperform, now it makes sense to concentrate. Whereas in a period like 2024, risk reward was not right for you to concentrate. So that's broadly how we think about concentration and why you will see lesser number of companies today, the top 10 weights being a lot higher. And we'll cover that in terms of the single stocks, but at least from a macro perspective. So the sum total of all of this is from a macro perspective, I covered where I want to be underweight, which is first the process of elimination. Second, from a risk perspective, why we want to be concentrating, fewer number of names, larger exposures, why we want to be building it. And now we'll go into the three large sectors which contribute almost 70% of your portfolio today, right? And we'll go into the details from a single stock perspective also. Now, for a good part of 3.5 years, we at Itus have been underweight banking, right? Now, why? And it has nothing to do with valuations, right? Because valuations were cheap in 2022, were reasonable in 2022, cheap in 23, and cheaper in 24. So why are we increased, or why have we increased our weight in banking aggressively? So broadly for us, banking is a function of liquidity in the system. So the chart out here tells you the interbank liquidity, how it has changed over the last 7+ years. And you will see liquidity drop off from 22, which is where we started to cut our weights in banks. End of 23, the ex-RBI governor spoke about increasing the risk weights on banks, which means cutting liquidity even further. And you'll see the liquidity drop for the good part of 2024. Now, the new governor is talking about loosening those limits, which means we should expect this liquidity to start going up from here. So that's your first data point that you need to think about. Second is, what we have done on the chart on the left is to plot the credit growth along with deposit growth in the system. This is a system, it's not for one particular bank. Now, many people in 23 asked me, okay, when the credit growth was at 20+%, which is extremely robust, why are you underweight banks? It makes no sense. The reason for that was credit growth alone does not mean banking will do well. Banking generally tends to do well when credit growth aligns itself with deposit growth, which means your CD ratio does not go up. Because every time your CD ratio goes up, the RBI gets concerned and says cut lending. And that's exactly what happened. Because when credit growth was at 20+%, deposit growth was only 15%. So the gap meant that CD had to get cut. So credit growth had to fall. That's what you saw in 2024. And now for the first time, your CD ratio gap is the lowest that's been in the last 4 years, which means now the RBI can say, go and lend more, because now my CD has fallen, systemic risk at least is reduced, now I want you to lend more. So if you look at this in conjunction with the bank credit to NBFCs, you will see after a period of 2.5 years, the credit growth picking up very early to conclude right away, but a small uptick you will see, right? So broadly, liquidity is going up. Credit growth has first signs of picking because CD has fallen. The last part, which is deposit growth. Here again, for the good part of 3.5 years, incremental flow from deposits, if you compare it to incremental flow to mutual funds, need not be equity or debt, just to mutual funds, that number kept reducing because incremental rupee went to MFs. Over the last 5 months, here again, I'm not talking about gross, I'm not talking about net. I'm just talking about incremental flow of a rupee to the deposits to the MF ecosystem. We are again seeing a turn after a period of 3.5 years, which means it's good for the deposit ecosystem. So put all these three together, you have all the conditions for the ROA in the system for banking to expand, which is what we look for. So now you combine it with valuation not being expensive. That is the reason we want to be overweight banks. Here again, like I said, I'm not going and buying all the banks. We have HDFC Bank being our largest position, ICICI Bank being second, and Bajaj Finance in the NBFC space. There are 3 lending institutions that we own today. Other banks could do well, but again, we want to be sticking to higher quality as we speak, basis the market that we are going into. The chart on the right just explains to you from a HDFC Bank perspective, how the CD ratio has been moving. So the CD ratio has been coming down, which is good for the bank. We expect this to somewhat bottom in the next 2 quarters, that will be close to what we expect your ROA bottom for the bank. And we expect from there the bank to be doing well, or rather, put another way, ROAs to expand. Now, moving on from banking to consumer. So in consumer, we split the risk between staples and discretionary. We obviously own discretionary and it's well owned. Everyone has been talking about it, but discretionary is valuations are not cheap. So we don't have a large overweight in discretionary, but we have a contra positioning in staples, in FMCG. So I'll just take you through the thought process around what we own and why we own what we own. So if you look at the chart on the left, it tells you the domestic mutual fund positioning in staples. So staples is your FMCG, right? So in June 20, that was the peak. It was at 7.6%. So 7.6% of the entire MFAUM is in staples. From there, it's been continuously coming down. And today it's at the lowest, close to the lowest at around 4.6%. So this is the DII ownership. The right is the FII ownership of single stocks in the FMCG index. So as you can see, barring one name, all the FIIs have also been cutting their FMCG exposure. So why are we bucking this trend and buying two names that we own? There are two things that we are seeing on the ground. First is, after a period of 4 years, for the first time, rural inflation is picking up. Why does that matter? Because as inflation picks up, for the first time, FMCG companies can raise prices. So it gives you pricing power, it gives you margin expansion, something that's been lacking for almost 4 years now. And the reason DII and FII have been cutting is because growth has been lacking, as a result of which in the last 6 months, the FMCG index is down 24%. It looks like a small cap, not an FMCG index, because for the last decade, there was growth and FMCG was a good place as a defensive positioning for you to get risk-adjusted returns. It no longer is the case. So we own two companies, or rather you would have seen portfolios have exposure in two companies that we've been buying since January, ITC and Marico. Why have we been buying this in the last 2-3 months? So one of the reasons FMCG companies have been struggling is, as quick commerce has penetrated, the general trade distribution channel for FMCG companies have taken a big hit and margins have come down. Now, two companies which have been taking their own initiatives are ITC and Marico. ITC, for example, has been covering and expanding its direct coverage, directly connecting to farmers. This number was almost close to zero 3 years back. Today, they have directly connected 1.7 million farmers across 10 states, and they continue to expand this through their ITC Mars program. Marico, on the other hand, they've been directly connecting to the GT channel in order to circumvent this quick commerce. Even Marico roughly has 9% of its sales on quick commerce even today, but they've been building the digital channel and that's expanding. What's the implication of that? Marico, which was a single category brand, which is predominantly coconut oil 3.5 years back, looks more like an FMCG brand where 22% of its product portfolio has higher margins. So over the next few quarters, you will see not only volume growth, you should see margin also expanding for companies like this. And hence, after a period of 4 years, these are good companies according to us, where you should see a incremental rate of change of growth, which has been lacking for almost 4 years. So here again, I'm not saying every company is a buy. We don't own a Beavers or we don't own a Nestle. We would be stock specific and selective around those where we are seeing change on the ground, and those changes have resulted in product portfolio differentiation. One of the reasons the portfolio had a drawdown in Jan specifically was our pharma exposure. As you are aware, there have been enough and more headlines, and they will continue to be headlines from the US on what they want to do with generics. It's been our view that US will not want to manufacture generics in the US, primarily because at these prices, many of them actually make losses even at the EBITDA level. So you can see most of the CEOs talking about saying these prices are unsustainable and this does not make any sense. So when you put a tariff, be it on China or be it on India, what you are doing is you're raising drug prices. So even if in the worst case outcome of a 25% tariff increase, the EBITDA margin of these companies should see an uptick. So we have not actually done anything to our pharma exposure. In fact, we've kept it as is. So our exposure is across hospitals, generics, Indian branded and CDMO. In CDMO, we own a company called Pharma, which has been expanding its CDMO pipeline in what we call as phase 3 molecules. So their expansion has resulted in fairly strong growth. In fact, they operate in what is called the ADC segment, and it's one of the 4 companies globally to have expertise in this scale. So this, according to us, can potentially play out into a long-term 5-year story, but we have to risk manage it because there can be what I call as drawdowns along the way. As you can see, the peak to trough drawdown that Pharma went through in 3 months was almost 32%. So you will see not more than a 3% exposure in Pharma across portfolios. So put all of this together, how will our portfolio look like? If you look at it, it will look at a 2/3 exposure in large caps. Like I said, just because concentration is building up doesn't mean you have to sell your mid and small cap point blank, but you'll have to be a lot more careful in terms of where you want to position. The top 3 sectors almost make up 70% of our portfolio. And that's what I was talking about, concentration getting built into the portfolio. Today, if I look at what are my expectations for the year, over the next 4 quarters, like I said, I expect narrowness in earnings, which means you'll see a lot more volatility from a stock specific perspective. The biggest risk for me is not tariffs. That is a supply chain risk. So I'm not going to harp on that. The biggest risk for me is today the analyst community has a 14% earnings growth for Nifty 50 over the next 1 year. I personally think if we get to 9%, that would be my base case. So you should see over the next 1 or 2 quarters more stock-specific earnings downgrades. You do have a weak macro, but your RBI and the central bank is coming in both through monetary and fiscal measures. So earnings growth will come through selectively in pockets. What I'm though fairly incrementally confident of is FII flows. You should see them coming through in the next 2 months, and that should increase for the good part of next year. If you look at FII flows, they've been structurally reducing. So today, for the first time, your DIIs in India own as much of India as the FIIs. It's never happened in the last 20 years. So if FIIs actually come back, which is what my base case expectation is, and DII is not really pulling out significantly money from the market, you should see flows being supportive. So macro is not in a great place, but at the same time, policy is supportive. Earnings, there can be incremental flows of earnings downgrades, but that will get supported by flows coming through. So you have a push and pull factor. So net in this kind of a market, what should you expect? I think base case, I would put my hand and say Nifty 50 should give you a 9 to 10% price performance from here into the end of next year. And in that kind of a market, if you look at our portfolio, you should see at least a 5% outperformance basis how we are positioned. That's what I would guide for sitting today. So that's broadly how I would take you through what you should expect over the next 1 year. The last slide, because there is noise on tariffs, just to explain from a very simplistic perspective today, India has a $30 billion deficit with the US. Away from the US, we import oil, which is our biggest import category. So if we can move $15 billion of that into the US and import additionally, you should expect us to cut the duty on auto. So we could import more of auto. For us to manage this deficit should not be such a hard task. So I think the smaller countries, especially India, Japan, Vietnam, Korea, should balance it out over the next 1 month. Elephant in the room is how things pan out between the US and China, which I don't expect it to be very smooth. So that's broadly how I would think about it as how noise or headlines come out over the next 1 or 2 months. So I'm going to end the call here, and then we'll open up the floor to questions. Any questions, we'll look to answer them one at a time.
Thank you, Naveen, for the update. Investors can type in their questions in the Q&A button. Identity of investors are protected as the questions are only available to the panelists. Naveen, I have a question here. Now, do you see India becoming a favorable destination for FII money, especially in the emerging market space?
Yeah, I think if you can take a long-term view, when I say long-term, a 3+ year, over the last 15 years, the home for capital, or rather the default for capital, was the US. India, China, they were all pockets that people would come to and go out of depending on valuations and growth. And I think that thesis is at risk today for the first time, both in terms of how I view dollar and how I view US equities, especially the Max 7 and the tech stocks. So it is my fundamental view that FIIs now have to readjust this, which means capital has to flow into the EMs. Now, India will benefit out of it. China will go from on and off because China has other issues also. So if you take a 3-year view, answer is yes. In the short term, answer is yes too, because valuations have corrected. So FIIs are again relooking at India. And that's why I say that over the next 2-3 months, you should see flows, which has been negative for a good part of 2 years, turn positive. And that can build momentum as growth builds back. I don't expect growth to build back immediately. Like I said, we need 4 to 5 quarters of normalization of growth. And post that, you should see growth come back. So yes, I am positive on FII flows coming back.
Understood. Got it now. Thank you for that. Now, on the portfolios, so do you believe the portfolio concentration which you spoke about for at a client level, would that concentration happen over the next 1-2 months for the broader client base, or it's for specific clients over a time?
See, today, if you look at new clients, for new clients, we own 24 to 25 stocks. Some of the older clients, we would have cut down the tail from 39 to almost 32. There would be a few tail positions in the older clients that we might cut down even further and concentrate into some of the existing businesses. So concentration just does not mean the number of stocks that we own. I look at concentration as how is the top 5 contributing to your overall portfolio, how is the top 10 contributing to the overall portfolio, and also cut the number of stocks from a tail perspective.
Understood, Naveen. Got it. Naveen, now, how do you see the tariff war between China and US impact India?
The answer is no one knows, neither do I. But if I look at, you're dealing with two individuals, both of which are egoistic and are dealing with the largest economies, because China in 2015 is very different from China in 2024. China has been preparing to the best way possible for something like this. What do I mean by that? Post COVID, when supply chains got disrupted, China has been cutting the exports to the US and has been exporting to Africa, Southeast Asia, and the rest of Asia as well. Obviously, it cannot export all of it into these regions because US is still the world's largest consumer. Second, if you look at what is going to drive the world in the next 10 years, I think no one is going to argue that the next 10 years, the powerhouse in terms of GDP is going to be driven by investments in AI. And if you believe AI is what is going to drive the world, the ingredients for AI are chips, power, and data centers. And China is best placed in all three. China has invested in power to the extent of 5 times that of US. China now has a chip making capacity also that they have been investing behind. Not as large as Nvidia, obviously, but still they have. And China has access to the world's largest mineral base and power. So they don't need to be budging to the US needs right away. So I do think it can turn messy before before there is a longer term resolution. How long or how many months it takes, I don't know. But the market is already saying that in terms of how it perceives China, how it perceives US, and how it perceives the rest of the world. So I do think you are going to be getting headlines on tariffs. But broadly, if you look at it, I think somewhere for us, we should have some kind of an interim resolution over the next 30 to 60 days, is my base case assumption as we speak.
Understood, Naveen. Thank you for that. Naveen, do you see the tariffs being implemented into the pharma industry in the near term?
I think Trump, at least from a headlines perspective, says he wants to. But if he says he wants to, practically, he's going to shut out drugs coming into the US. US generic manufacturers have not been investing in the US for the last 3 years. So what this means is prices of drugs will immediately shoot up. Trump has an interim election to go into in 2026. No president has gone into an interim and seen inflation peak up and come out winning on the other side. So odds are, even if he does it, probability wise, he cannot implement it from a longer term perspective because there is no solution or a backup manufacturer. So broadly, I'm saying, even if from a headline perspective, he says he wants to protect the pharmaceutical industry, which he would want to, practically, it doesn't seem likely that he can just implement it right away. And China can do the reverse as well. China can say, I'll stop exporting drugs to the US. And that could hurt the US even further. So there is a lot of ramifications around each one of this. I cannot say with confidence saying that he will not put tariffs or he will put tariffs. But what I can say is if he puts tariffs, it will hurt inflation in the US.
Understood. What is your view on metals, especially gold?
So in my worldview, again, see today, I think people are buying gold for a trade, for returns. Gold is meant to be a part of your portfolio. So there is a lot of speculation that's going on in metals. If I take a 3 to 5 year view, I still think gold is heading higher, not lower. And especially with a view like what I laid out, where dollar can depreciate structurally, which means metal should go up even further. So I am bullish non-ferrous metals, be it gold, silver, copper. With a short-term perspective, obviously it can be volatile, but with a 3-4 year view, I still think gold is heading higher.
I have a question here now. It's in different parts. So first I'll go with this. How do you think the Indian government is focused on Capex? And how do you see domestic consumption playing through this?
See, in terms of the government, so far they have not said they're cutting Capex by any stretch of the imagination. Even if you look at their focus areas, which is in power or transmission, it seems fairly robust. Now, what I laid out to you is what we expect. And if that's what we think is the most likely path. Now, what could happen? Working capital cycle of companies that deal with the government can expand this year because your revenues are not as robust as you budgeted to be. That's the risk that you run. So Capex could undershoot in terms of execution versus what they announce. That's the base case that I think could happen. Now, how does it impact consumption? See, I think Capex alone need not go into consumption because you also have a 1 lakh crore tax break that the government is giving. So consumption can be stirred up by liquidity, consumption can be stirred up by lower rates, and consumption can be stirred up by what you call as Capex. So one leg of consumption from Capex may not flow through, but there are 2-3 other legs from what I call as lower rates, liquidity, or the tax break that you've given that can stir up consumption. So you will have to think about it from all the 4 angles.
Oh, understood. How do you see the power infrastructure in India? Do you see it improving?
See, I think obviously the government is committed to higher transmission. Government is committed to digitization of the existing infrastructure. So if you play a 5-year theme, power should do very well. But as a public markets fund, we will have to balance both the short term and the medium term. So if I look at it from a short term perspective, I feel that there are better pockets to position yourself, especially because many of the power companies are state, you will be facing the central government. So working capital cycles could increase. Valuations are cheap, as a result of which maybe there is a trade. So we would monitor it, but at the same time, I think we would play it through other names, consciously saying that over the next few quarters, you might get a more what I call as better levels in order to invest. So from a 3-year perspective, I still am bullish power. From a 1-year perspective, I am slightly cautious.
Understood that. Now, Naveen, do you see the earnings of private banks increasing?
I mean, yes, in the base case that I said, you might see this quarter's numbers having a NIM compression because RBI has just cut rates. The market is already aware of that. Market, you will have to look 2 quarters out when you invest. So the rate cuts. So if you look at this quarter's numbers and you say, and headlines might read NIMs are lower, but that's expected. When the RBI cut rates, and you would already factor that into your model. So that should not come as a surprise. But 2 quarters out, if you look forward, you should see ROIs expanding from here. So that's what we have invested behind. So yes, earnings, I'm not talking about March quarter numbers, but if you look at September 25 numbers, you should see a fairly strong, both a credit growth, NIM expansion and an ROI expansion.
Understood, got it. I mean, now, how would you see if a client has to deploy money? How would you advise it? Would you say invest everything right now, or do you want to stagger it over a period of?
So I'll tell you how we are deploying for new clients. So in February, when the market was going through the tariffs, we were deploying close to 85 to 90%, with balance keeping around 8 to 10% in cash. Today, for new clients, we are deploying close to 67 to 70% immediately. And over the course of next 1 month, any volatility will ramp it up close to 80 to 85%. Somewhere by end, so into the earnings quarter, as earnings come out, I would want to keep roughly 10 to 15% in cash and get ourselves deployed by somewhere around mid-May. That's where the end of earnings season will finish. So, like I said, I'm not bearish, but investing in which sectors and which companies becomes extremely important. If you ask me the word market, I would say Nifty 50 maybe has bottomed, but mid and small cap, I cannot say with the same level of confidence.
Understood now. Thank you so much, Naveen, for answering the questions. Over to you, Maggie.
Thanks, Naveen and Ajit, for this session. Thank you all once again for your patience on this call. The recording of this webinar will be sent out by the end of this month. Thank you once again.
Thank you to everyone for attending this call.